What's up everybody, Nate here. And First Republic Bank just completely failed and had to be taken over by government regulators, following in the footsteps of Silicon Valley Bank and Signature Bank. First Republic's collapse and failure is now the second largest banking collapse in United States history, right behind Washington Mutual's $307 billion default in 2008. First Republic Bank was essentially saved by the United States government and JP Morgan Chase, as JP Morgan is going to acquire most of First Republic Bank's assets. JP Morgan Chase is the biggest bank in the United States and one of the biggest banks in the entire world, and it just got a whole lot bigger because of this deal. So today I want to talk about what happened with First Republic Bank, what all of this is going to mean for you and the banking sector, and what we can expect in the future. All right, so like I said before, following in the footsteps of Signature Bank and Silicon Valley Bank, First Republic Bank had a very similar problem of uninsured deposits and taking huge losses on a lot of its assets. If we follow the basic timeline here, well then you can see First Republic's problems basically started along the same timeline as everybody else's problems. We're talking about Credit Suisse, we're talking about Signature Bank and Silicon Valley Bank. So a lot of these banks have been put under pressure because the Federal Reserve has been raising their interest rates. Now that affects banks pretty directly because banks work with the Federal Reserve to get their money, and they also have a lot of assets that those returns are going to be determined based on Federal Reserve interest rates. So Silicon Valley Bank and Signature Bank were investing in a lot of high-level wealthy deals and a lot of high-level wealthy businesses. So we're talking a lot of tech startups, we're talking a lot of fintech startups, all of these different businesses throughout the United States who typically are going to be very volatile depending on what is going on in the United States economy. Those banks ended up failing because all of their assets were losing them a ton of money. And when people saw all of these assets were losing money and the bank maybe was not going to have all of their funds readily available if they went to the bank, well, people pulled their money out, and then the bank did not have any amount of money in order to cover its costs, and that is exactly what happened with First Republic Bank. First Republic Bank holds a lot of assets in real estate and a lot of startups, and because a lot of these investments and businesses are now starting to go down in value and their assets are losing value because the Fed is raising interest rates and investors are pulling out, that means First Republic Bank took a lot of losses on its assets, which means it has less liquidity in the bank. And if it has less liquidity, that means it's not going to be able to ensure that all of its depositors get their money back. This problem sort of went away a couple weeks ago because some of the largest banks in the United States, the top 11 banks in the country, actually deposited around $30 billion to First Republic Bank to make sure that it didn't fail. However, this issue got a whole lot worse very quickly because people got scared that they were not going to be able to pull their money out of the bank, and First Republic Bank essentially lost $100 billion in deposits. So now it has a whole lot less money in order to make money. So it can't invest, it can't give its depositors back. It's basically bleeding cash here. So that $30 billion kind of kept it afloat for a little while, but then the Federal Reserve continued to raise its interest rates and it continued to take on losses, which was a bad sign for the bank. So then what First Republic Bank decided to do was, in order to make sure that it was going to be able to give its depositors their money back in order to continue to facilitate its business as a bank, it took on some big loans from the Federal Reserve and some other banks. So that way it would have even more money in order to pay back depositors. It also decided that it was going to cut around 25% of its staff, and it was also going to sell off a bunch of assets so that way it had a lot more liquidity. Its main goal over the last few weeks was to make sure that it had insured deposits for all of its depositors. So this meant that it had the money in the bank in order to give back its depositors all of their money, because most of the deposits that First Republic had were in uninsured funds. In fact, around 90% of them were in uninsured funds, which means that 90% of the people who had money at the bank might not have their money returned if the bank failed. So that really scared people, and that's why $100 billion essentially left the bank. Well, it hasn't really been able to do that, and as of this morning, government regulators in California officially took over the bank, and now JP Morgan Chase bought most of its assets. But the bigger question here is, why would JP Morgan do this? Why would JP Morgan and a bunch of other banks get together and fund money to help a struggling bank? Well, this is a pretty sweet deal for JP Morgan Chase, especially with the size that JP already is. JP Morgan Chase took all of the deposits that First Republic Bank had and all of its customers, and also it took all of their good and bad debts. After the 2008 crash, there was regulations that were passed that no bank in the United States was allowed to have more than 10% of all US deposits. So no bank could hold 10% of all consumers' money, but because of the recent banking turmoil, the government has decided to lift those regulations a little bit. And now JP Morgan Chase has well over 10% of all US deposits. So this kind of creates a risky situation for the US government, but it also shows how desperate the US government is to not see a full-on banking failure. And for JP Morgan, it's sort of a situation of being too big to fail because now they have way too many of Americans' deposits and they almost can't fail now without government intervention because too much is at stake. Too many people, too many businesses, and too many investors would lose money all at once if JP Morgan went under. JP Morgan now has around $4 trillion worth of deposits and assets on its balance sheet, definitely making it by far the largest United States bank. But like I said at the beginning of this video, so this was a deal between JP Morgan Chase and the United States federal government. So the United States federal government decided to help out JP Morgan by giving them a backstop of around $25 billion. JP Morgan is going to have to front around $10 billion of that up front, but most of that money will be returned in time. At the end of the day, this is going to take a $50 billion hit to the FDIC system. That is the Federal Deposit Insurance Corporation. So basically what that means is all of your major United States banks get together and they funnel money into an insurance program. So just in case one bank goes under, all of these banks have put money into basically a pile that will ensure that all of the depositors at that failed bank get some of their money back, up to $250,000 worth of their savings. But like I said before, a lot of these wealthy individuals at First Republic Bank, at Signature Bank, at Silicon Valley Bank, well, they had a lot more than $250,000 in the bank, so they wanted to move their money because most of their funds were uninsured. The CEO of JP Morgan Chase, Jamie Dimon, believes that this is pretty much the end of the major parts of this banking collapse, and we've pretty much rode out the hardest parts of the storm at this point. With the United States sort of fronting a lot of money, it's a lot less than what happened with Signature Bank and Silicon Valley Bank, only around $20 billion worth of a government backstop. But keep in mind here that this government backstop affects you directly. Even though the government has said that this backstop is not going to directly take taxpayer money, it's still going to end up costing you because of how banks work. When you deposit, say, $100 in the bank, well, the bank essentially takes this money and loans it out. It takes it, puts it into assets, or it gives it to people looking to take on a loan. The bank does not just keep that money sitting in a savings account waiting for you to come back for it. The bank would not really have a way to make money off of that, and it would just simply lose value due to inflation every single year. So that $100 sitting in the bank is a huge liability for the bank. So like I said before, the bank loans this money out so they can make money. They can make 10 times your $100 investment that you put into the bank. And don't worry, banks will have that $100 when you go to ask for it back. But it becomes a problem if everybody comes back all at once because we have something in the United States called the fractional reserve lending system. Banks take your $100 and loan out 100% of it, but they're not required to keep 100% of depositors' funds on hand at all times. They only have to keep a small fraction, so just in case a few people come to the bank and ask for their money back, well, the bank will have the money to give them. Now that you know how banks work and you know how banks make money by loaning your money out, well, that means when you put money into the bank then takes this money. The government backstop involves charging a fee to all banks in the FDIC system. That way it can cover the backstop and make sure that all of the depositors from First Republic Bank get their money back. But government's charging the banks, well, the banks just have your own money in their own deposits, so that means that they're using your money to pay the fees. Now, what can you expect as a consumer, as somebody who uses banks or an investor or just somebody looking to kind of pay attention to this whole banking situation in general? Well, banks, businesses, startups, you name it, everybody in the United States right now is hurting because of really high interest rates and slower consumer spending. That is why we have seen a lot of layoffs in 2022 and in 2023. Businesses don't have the same amount of liquidity and the same amount of money that they used to have to pour into their own market and to invest. So they're not doing that because interest rates are really high. That's leading to a big drop in assets, which is completely planned by the Federal Reserve. We have all of these assets, we have all of these big bubbles in pretty much every single market and industry in the United States. That's why prices are so heavily inflated and we've had this big inflation problem. The Fed wants to make it expensive. It wants to make it really difficult for banks and for businesses businesses and investors and consumers to borrow money. That way they don't do it as much, and in theory, demand will go down and so will prices. Federal Reserve has raised their interest rates pretty much consistently for the last year or so, and as long as those interest rates stay really high, well, you're going to continue to see really difficult situations in the banking sector where banks are going to have a lot of losses on their assets, and businesses are going to have a lot of losses too, and they're going to start cutting people. That creates sort of a rotating problem because now nobody is making any money, and there's a lot more money going out than there is money coming in. Now, of course, you as a consumer and somebody who uses banks, well, you can't control that. Now is not the time to sort of look at the banking situation and decide that you're not going to keep your money in banks, right? Now is not the time to sort of lose your trust in banks. Now is the time to sort of look into what bank you're using. You always want to do your due diligence when you're investing money, and of course when you're putting your money anywhere, and that includes a certain bank, and that includes spending and taking on debt right now. Banks are not inherently bad. They're actually a really secure place for you to hold your money, and in some cases you can actually make a really good interest rate on all of your savings, but you gotta know how the banking sector works, and you gotta know what to do with your money. We go through these periods in the United States where we have really high periods of economic prosperity, and we have periods where we're in a recession, and being financially educated and knowing what to do with your money is going to help you sort of remain successful financially in pretty much any situation because you have a plan in place for it. Because at the end of the day, you can't control what the banks do, you can only control what you do with your own money, and that is way more powerful than I think people realize sometimes. You definitely don't want to wait here until the next bank collapses or something else crazy happens in our economy. You definitely want to have a plan in place and watch what is happening in the business and financial world. And if you want a really, really easy way to do that, we are covering all of this and much, much more over on Market Brief 6 days a week, and you can subscribe for free by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.